what's going on? Welcome back. Ryan here. In this video, we're talking about call debit spreads and put debit spreads. Okay, so in the last video, we talked about call credit spreads and put credit spreads, right? Where if we remember, we sold an option closer to the money and we bought an option farther away from the money, creating that credit spread. And in this video, we are going to look at the other side of this trade, which is the call debit spread and the put debit spread, right? So again, if we use Apple as an example, if we think Apple is going to go up, right, and we come in here to our options chain and we look at where Apple is, right, $172.99, and we think Apple's going to go up. Well, remember, if we thought Apple was going to go up, we could sell that put credit spread, right, which would be where we would sell like the 170, you buy the 165, and now we have that put credit spread where we make money if Apple goes up. Okay, and I'm just going to turn this off and leave this here, because another way to create the same sort of trade is where we use a call debit spread, right? Where if we think Apple's going to go up, we could buy the 180, right? So now we're buying the call that's closer to the money, and we're going to sell a call that's farther away. So for instance, we buy the 180 and we sell the 185. And again, this is going to create what's known as a bull call spread or a call debit spread, where when we analyze this trade now, it looks very similar to this vertical spread, right? If we look at, here's the put credit spread, right, where we're putting this on as a credit, right, and we're using puts, but the P&L and the way it looks is very similar. It's identical, right? And important to understand that we can have the same result, the same bias, right? Our assumption that Apple's going to go up, and we can use the call debit spread. We could use the put credit spread, right? We could use the butterflies. We could use the calendar spread. We could use buying the calls, right? Selling the puts naked. Important though to just understand how we, get these P&L graphs the way they look, and understanding what it exactly is that we're doing. So again, for debit spreads, it's the opposite of the credit spread, right? So again, we bought the 180 and we sold the 185, okay? Now, on the other side of this, remember, if we thought Apple was going to go down, right, we could have sold the call credit spread, right, where instead this time we sell the 180 and we buy the option that's farther away from the money, creating, right, this credit spread, right, which gives us this bearish P&L graph, right, where if Apple goes down, we will keep this credit, okay? And now the other part of this trade, right, is similarly, if we think Apple's going to go down, but for whatever reason we didn't want to use a call credit spread, we could use a put debit spread, which looks the same except it's a debit, right? So if we thought Apple was going to go down, right, we could buy the 170 and sell the 165, and again, this would give us a trade that again looks very similar, right? So here is our put debit spread, right? As Apple goes down, we're going to make money. Our risk was 197. Our profit is 303 potentially. But remember, here is the call credit spread. Here is the put debit spread, right? The P&L graphs look very similar. And again, with these debit spreads, the risk always lies in when the underlying security settles between your strikes, right? That is what you don't want. You don't want to open yourself up for that type of assignment risk. And again, when we look at the debit spread, so for instance, what happens if we what happens if we buy a put debit spread way out of the money, right? So again, let's go to the 10 deltas, right? So here's our delta. We will buy the 45. So right now we're buying the closer option and then we're selling the 140. And with the debit spreads, it works the opposite, right? Remember, with the credit spreads, the farther out of the money we sell the credit spread, the worse the risk to reward is. The opposite is true with the debit spread, right? So when we buy the debit spread out of the money, we get much better risk to reward, right? So on this trade, right, we're on a one lot, we're risking $42 to make potentially $458. But again, of course, Apple would have to make a huge move to then get to where we would make money. Obviously, if it made a quick move down at this time, like based on the time value, this could be making money. But the most important thing, again, is knowing where we're going to lose, right? So with the debit spreads, again, the farther you put the debit spread away from the money, the better risk to reward you're going to have, as opposed to, right, if we were to do something where, if we look at in the money here, right, if we buy this 190, we sell the 185, we're not going to get very good risk to reward here, right? We're risking 397 to make 103, right? As opposed to, again, buying a debit spread kind of out of the money, right? Where here, if we do the 34 delta, we buy the 165, we sell the 160. Again, we will have better risk to reward, where when we look at this, right, we're risking on a one lot, we're risking 150 to make 350. And just really important with both the credit spreads, debit spreads, that we understand where the risk is, right? The risk is always in assignment at settlement, and to understand when we're putting these trades on that we can control our risk by how far or close to the money we put these on. So remember, with the credit spreads, the farther away from the money you sell the credit spread, the worse your risk to reward is going to be, right? The closer you sell the credit spread to the money, the better risk to reward you're going to get. For the debit spreads, it's opposite, right? The farther away from the money you buy that debit spread, the better risk to reward you're going to have. And again, on the other side of that, when you buy debit spreads closer to the money, the worse your risk to reward is going to be. Okay, so again, really important to understand these vertical spreads, right? They can be invaluable tools when you're starting to trade very expensive assets like Amazon, right? Amazon options are extremely pricey, but people like trading Amazon because Amazon can really move, right? You know, a 10% move in Amazon is a huge number when it comes to the leverage that you can use in options, right? So, for instance, if we think Amazon is going to go up from here, right, we have all these different choices we can make. But if we look at these 30-day out options, right, to buy the 70 delta option on Amazon 30 days out in the money, right? I mean, it's a on a one lot, it's a $20,000 option, right? So a better way to use your capital is to just use debit spreads, right? Or credit spreads, right? So for instance, if we were going to do a call debit spread where we think Amazon is going up, we need to figure out how wide we're going to make that spread, right? So for instance, remember, with the debit spreads, the closer to the money you put the debit spread on, the worse your risk to reward ratio is going to be. So if we look at, so 34.58 is this mean price right here. So maybe, and it's trading it at 34.08. So maybe if we did the 34.20, right? So if we bought this 34.20 and then we sold this 34.50, right? That's a 30-point spread. And now instead of having to shell out $20,000 for one option, what we can do is we can put on this trade, right? Where we're doing a call debit spread slightly out of the money, where our risk to reward is a little bit worse than 1-to-1, right? So on this trade, we're risking $1,600 to make $1,400, right? Which is a much more a much more efficient use of our capital, right? Which is the ability to make money on an asset like Amazon without having to spend a ton of our capital, right? So again, what we could look at here is, okay, we could do this 30-point debit spread, call debit spread, right? Or again, we could come in here and do the opposite, where we sell, right? We could sell this 34.10 and we could buy this 34.05, right? A 5-point spread. And I don't even like the way those numbers are. So let's go even more into the money. If we think it's going to get to 34.50, we could sell the 34.20, buy the 34.15, and here we might be able to get, again, half of the spread value, right? So risking $250 to make $250, right? Again, these look exactly the same, right? The graphs look the same, but again, the risk to reward is much different. One of these is a 5-point spread where we're getting half of the spread as a credit, and the other one is a 30-point debit spread where we're risking $1,600 to make $1,400. So again, I know this is a lot of information, but I know that it's gonna work for you because, if you love trading, if you love making money, if you love investing in yourself, these are extremely powerful investing techniques that you can use forever, right? You can make money with these a lot of the times regardless of what the underlying asset does, right? Because we're able to have such granular control and authority over our risk and the way we put these trades on, right? Whether we use credit spreads or debit spreads or buying calls or buying puts outright. Again, options trading gives us an incredible amount of freedom. And at the end of the day, we all want freedom. We all want to be confident. We all want to be able to, make high quality decisions. And I know the more you study, the more you learn, the more you apply yourself, that's exactly what is going to happen. So again, having a great time. I'm thrilled you're here investing in yourself. And if you have any questions, reach out to me, and I will see you in the next video.